Imagine looking back a few months from now and realizing this was the moment you quietly positioned yourself while everyone else panicked. While the headlines screamed fear, you were here, getting the kind of intel most people never see. Welcome to Generational Wealth Insiders Club, your pathway from knowledge to legacy. Happy Thanksgiving, insiders. We're extremely thankful for you. Today we're breaking down exactly what this November chill in crypto really means for long-term wealth builders, where the smart money is moving, and which narratives could shape the next leg up in this cycle. Let's start with the big picture. This month has been a playground for bears and an emotional stress test for everyone else. Bitcoin, the digital gold standard, recently saw a sharp single-day drop of just over 7%, briefly breaking down into the mid-80,000 range before bouncing. Sentiment is deep in extreme fear territory, which historically has been where smart capital quietly accumulates. Despite the pain, there's a powerful countersignal. Spot Bitcoin exchange-traded funds flipped green with well over $100 million in fresh inflows in a single day. Major institutions like BlackRock added tens of millions of dollars in both Bitcoin and Ethereum exposure. That's not retail emotion. That's professional money buying the dip. On the macro side, we're dealing with hawkish central bank signals, tariff and policy uncertainty, and a massive evaporation of total crypto market capitalization since early October. Ethereum has also taken a hit, sliding roughly 7% into the high 2,000 range. But again, under the hood, you've got increasing institutional interest, especially through regulated vehicles. That tension between fear and quiet accumulation is exactly where asymmetric opportunities are born. Now, let's zoom into key events shaping this environment. The Federal Reserve's Payments Innovation Conference is putting crypto, stablecoins, and artificial intelligence directly on the regulatory radar. That's important for us as long-term builders of generational wealth, because clarity is the bridge between speculative hype and deep institutional adoption. We're seeing narratives from major payment giants calling Bitcoin's moment a new era of clarity and confidence, while at the same time, major exchange hacks like the one hitting Upbit are reminding everyone of a simple rule. If you don't control your keys, you don't fully control your wealth. Add in state-level moves like Texas allocating millions into a Bitcoin exchange-traded fund, and you can see the slow but steady merge between traditional finance and digital assets. Sector-wise, artificial intelligence tokens are still leading relative strength, with several names posting double-digit daily moves recently. Real-world assets, tokenizing real-world value on-chain, are gaining traction as one of the clearest bridges between trillions in traditional markets and crypto rails. Payment-focused projects are heating up as well, helped by renewed excitement around XRP and cross-border settlement narratives. On the more speculative side, memecoins and airdrop plays continue to pull in degen liquidity, especially around ecosystems like Solana and Base. These can be powerful short-term vehicles, but for our Insiders Club focus, we treat them as tactical trades within a larger, disciplined strategy, not the foundation of a generational wealth plan. Let's talk setups and scenarios. Bitcoin is showing signs of potential bullish divergence on higher time frame charts. If it can continue to hold key support in the high 80,000 zone, there is a reasonable path toward a push into the low to mid 90,000 range over the coming weeks. Ethereum is hovering above important moving averages. Decentralized finance total value locked continues recovering. Ethereum retesting the high 3,000 region is on the table. Solana has pulled back into what looks like oversold territory on common momentum indicators. If it can reclaim and hold key resistance in the mid-150s, short-term relief moves into the 160 region become plausible. ETF inflows and ecosystem buzz are adding fuel to that thesis. XRP is sitting on a strong structural base around the low $2 area. It's growing speculation around potential ETF products and ongoing adoption for payments. A move toward the mid-$2 zone is a realistic upside scenario if the broader market cooperates. We're also tracking newer plays like Bitcoin-aligned Layer 2 solutions building on faster virtual machine stacks. Payments infrastructure projects aiming to be the Stripe of crypto, and early-stage utility memes that actually ship products. These are higher risk, but when sized correctly, they can dramatically tilt the risk-reward in a diversified crypto portfolio. On the caution side, certain Layer 2 and high beta alts have been hit with double-digit drawdowns. If Bitcoin decisively loses key support in the mid-80,000 area, That could trigger another wave of forced selling across the board. Memecoins with no clear catalysts could easily see 20% or more shaved off on a sentiment swing alone. For you, as a generational wealth insider, the goal is not to perfectly time tops and bottoms. The goal is to recognize when fear is creating opportunity, separate short-term noise from long-term adoption trends, position size intelligently so you can survive volatility and stay in the game. So here's your action framework for this phase of the cycle. 1. Review your core conviction assets. Bitcoin, Ethereum, and any long-term holds like XRP or XLM that you truly believe will be here a decade from now. Ask, if this dropped another 20 to 30%, would I want to own more? If the answer is yes, that's a sign you may want to plan for gradual accumulation on deeper dips. 2. Define your speculative bucket. Smaller positions and higher risk plays like new layer 2s, AI tokens, or selective meme coins, these should be limited to a small percentage of your total portfolio, with clear entries, exits, and invalidation levels. 3. Protect your downside. Prioritize security and self-custody. Avoid over-leveraging. And never chase pumps without a clear reason and a clear risk limit. 4. Think in cycles, not days. Historically, periods of extreme fear have been where life-changing entries were made by people willing to zoom out and act rationally, while others reacted emotionally. As members of the Generational Wealth Insiders Club, you're not here for quick lottery tickets. You're here to turn information into long-term positioning and long-term positioning into legacy. Use this November volatility to refine your strategy, tighten your risk management, and identify the assets you want to own when the next major leg up really begins. If you found this breakdown valuable, revisit your portfolio with these frameworks in mind and jot down 3 concrete adjustments you'll make over the coming weeks. That could be redefining your core holdings, trimming overextended speculation, or setting intentional buy zones instead of reacting to headlines. Thank you for being members of the Generational Wealth Insiders Club. Your commitment to learning, staying informed, and thinking generationally is what separates you from the crowd. We hope you enjoy your Thanksgiving holiday. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only, and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.